Hey, this is Sasha, and welcome to another episode here on Hungry for Returns, where I answer your trading and investing questions regarding the stock market from my own past successes and failures. And in today's episode, we're going to take a look at option calendars. So that'll be kind of the core topic. But before we do, if you have any specific trading or investing questions, visit our website at tradersfly.com, and you can submit your own question, either by voice or just writing it in, and you might be featured on the show. So today's question is all about, do you need to close an option trade if you're trading calendars? And if you don't, what happens? What's kind of the issue there? And the reason we're kind of covering this question is simply because we have a calendar course that's been released that we've just been working on. So it's a great course. A handful of people already have it. If you're interested in learning more about calendars or trading calendar spreads, take a look at our website at tradersfly.com, and then it'll link you up to the courses, which all our courses are on the website rise2learn.com. Rise with the number 2, LEARN.com. And you can head on over to the courses page, and you can go to the option trading section, and as you scroll down, you'll see there's the calendar kind of course here. Now, this course has a lot of modules, ton of modules, 41 modules, about 22 hours long. So there's a lot of content behind it that you're going to learn if you're looking to trade calendar spreads. So check it out if you're even somewhat serious, and look at the promotional video on this page, because if you do, then you'll get some clips here as far as sample clips directly from the course, and you'll probably learn a few things as well. Anyways, with that being said, let's take a look at kind of this question. Do we need to close out a calendar trade or a calendar spread? And if we don't, what happens? Well, let's say here, our calendar spread, if you're not sure what it is, it's really about setting up two spreads, because options decay, and as they kind of decay here, they decay slow at the beginning and then much faster at the end. So this is our rate of decay. So this might be let's say 90 days out, then here we might be 60 days out, how much money we're losing on a day-to-day basis. This might be kind of 30 days out. And what we normally do is we sell something at the 30 days that has a faster decay, and we buy protection further out, like 60 days out, and we capitalize on the difference between those two. So the one we get at 60 days protects our 30 days. Now that one still decays, but it decays much slower. So when we do this, we're kind of binding ourselves to risks in both directions right here. Now you could position it a little left or right, bullish or bearish. This is the price of the stock. This one is Netflix. And this is the profit or loss you would make on the left and right. Now here is our zero line. So as long as you're in this white line, which is today's line, and the green line is the line at expiration, as long as that white line is a little bit higher, you're pretty much good. If it's above that zero line, you're profitable. And here's our profit and loss. So you can see after a few days, you're making this $11 a day. You're making right here $60. So that's what you really end up doing, is that you're capitalizing on this right there from that theta. And that's because we're selling, let's say, the February, and you're buying March for protection. Okay, at the 380 at this point. Now, if the price goes up, you're in more favorable. Of course, you could position it, let's say, 370 more right at the middle if you want, or even, let's say, 360 if you prefer that as well. Now, if we look at this trade and setup, remember what's happening. Okay, what's happening is you have decay on February and on March. So as time moves forward and I close out our trade grid, remember, this February is going to continue to go down in time. So eventually it'll be 3 days to go. Now this March, the same thing. It's going to decay from 59 days remaining to about that 31 days remaining. So eventually you're going to have February right here with 3 days to go, and you'll have probably March over here with about 31 days to go. So that's kind of what's going to end up happening with time. Now, you can see that once this expires, you're capitalizing from this. But once this expires, you've gotten everything that you can from it. Now this is going to continue to expire, and this one is your buying. Okay, so you're buying the March and you're selling the February. When you're selling things, right, if you're a store, you want to keep selling things, right? When you buy things, it costs you money. Let's say I'm selling a bunch of shoes. So if I'm in the business of selling shoes, well, I first got to buy, let's say, 10,000 pairs of shoes. Well, that costs me money, right? Here, this is costing me money. It's further out in time. But if I'm selling it, I'm making money. So that's just natural in business. And that's what you're really doing, is right here, when you're selling, this one decays, right? So it decays right there. If I close it up, close up the other one, you can see I'm up $200, $300. Now that goes quick, but the issue is, well, I still need protection. This one, I'm losing money. So I'm losing $262 because I'm protecting it. I'm buying those pairs of shoes. I'm buying insurance. So you can see a few days later, you know, I've spent $432 on shoes, but I've sold $688. It's great to sell more than what you bought, right? And combining it, this is what allows that white line to get closer and closer to the green line. Now, of course, it's going to wiggle in here somewhere as well. But even if it wiggles over here, because sometimes you're buying things a little bit higher priced, lower price, right? Sometimes you can get shoes at a discount. If you're a wholesaler, you know, you buy more pairs, more quantities, you can get it at a discount from your distributor or manufacturer. So depending on where the price lands, just like here in the market, well, sometimes you might be up $204. Sometimes you might be, the price goes down, you might be up 116 here. If it's like right in the middle where you chose, well, you're up at 265. So you're just controlling the price risk here. Now, with time, this continues to decay, right? Continues to decay until, well, what's going to happen? Well, this is what's happening, is that the one you sold continues to decay, and that's a good thing. And you've maxed it out right there on that expiration date. That's the most you could make, $2,020. Now, after that, right here, you're losing $880 on the insurance premium that you've kind of purchased. So $220 versus, or $2,020 versus $887. All in all, you're making, you know, right here about $1,150. So that's great. But now the problem is, well, after that day, you got no shoes to sell. So this one is now gone. So all you have left is that one. So you, even though you're profitable, right? You're profitable about that $1,100. Now what's going to happen is you're going to keep losing money every day, because that theta, which is the amount of money you make or lose, is now negative. Whereas if we backtrack a little bit, watch that flip, boom. Okay, so when we were actually having both positions, when we're actually selling the option premium, we're up 146 right at the end of expiration, right? That's the most you're really making, because the theta decays the fastest the last day or two, right? Before that, you have about a 39 theta decay, and then 43, 48, 55, 64. And then you get to that 148, but after that single that you sold expires, well, once you flip that, and you're now on the other end, now you're losing $34 a day. Now, you still made money, right? You're up in positive territory, up $1,110, but now every day you're holding that other contract, you're losing money. And if you forgot about it, you could break even at this point, pretty much. And then if you still held it past this day, well, now you're actually in the negative, even though you were profitable. So you have to close calendar positions. So if it goes, let's say 5, 10, 15 days, you know, let's say 10% of your length, you know, if you, or maybe 30% or 40% of your length. So let's say you had a 100-day calendar position. Well, maybe 20, 30 days, 40 days later, you close it out. If you had a 5-day, maybe 1 or 2 days, you close it out. If you had a 30-day, maybe 10 days, you close it out, depending on how price moves in your favor and if you do adjustments, because if you do adjustments, you'll be in the trade a little longer. But here, you can see that, hey, if I'm up about 340, and let's say price is now moving a little too far, too fast to the upside, I might just close this out, and you're done, right? But you got to close both of them out. If you left it, well, you can see what happens, that eventually, even if you're in the sweet spot, if you leave these positions, well, now you're losing money. It's decaying from you rather than you making the money. So that's what's important to remember, is you gotta close calendar trades out. When it comes to iron condors or selling verticals, you don't have to close those out. You can let those expire. But with these, you gotta close them out. And especially if you're kind of short, let's say you did these on the put side, you may have some assignment risk problems. If you're short and in the money, that could create a little bit of problem. So definitely, 3 days before, make sure you're kind of out 5 days before expiration. That's always a nice safe bet if you're brand new to them. You gotta sell out the position or close it out, the calendar trade. And that way you're not losing money, you don't have assignment risk as much or problems. You're just safer, there's more liquidity there as well. You're not waiting till the last minute. It's always nicer when you take your money off the table. So I hope this makes a little bit more sense in terms of calendars and how they work and closing them out. And of course, if you have specific questions, then be sure to click the link in the bottom or here on this outro page. That way you can go ahead and ask questions, submit them by voice, or even write one in. But remember to take a look at our Options Mastery Calendar course, because that's really where we get into 20 plus hours of learning all about calendar spreads, from the risks involved, how to manage them, how to adjust them. You can see these videos are not just, hey, it's a 45-minute video DVD, that's one video. It's not. It's a lot of videos. Some are 25 minutes long, and we even get into trade examples. There's going to be a few winning trades, but also a lot of losing trades. So that way you can learn, hey, well, what's a different way to tweak it? What's another way to tweak it? And that's the whole point, is the more losing trades I show you, the better off you'll be. So that way you know and understand, how can I tweak it and make adjustments? Because my whole goal is to show you different variations of how to tweak these positions when you get in trouble. Otherwise, of course, if you just set it up like this, let it expire and price didn't move, well, now you just take it off and collect your money. Anybody can do that. But tweaking it, adjusting it, when to adjust, when to tweak it, that's the tough part. And that's just part of also getting some experience. So anyways, be sure to take a look at that course on our website, tradersfly.com, or the Rise to Learn website. And if you have any specific questions, reach out or get on our newsletter list. The links will be in the bottom or on this video as well. Thanks for joining me. In the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you in the next video.